Welcome to vTalkInsight, Risk Sentiment Daily for March 5th, 2026. A sharp Middle East energy shock, heavy selling in Asia, and a rebound in U.S. equities are colliding today, leaving risk sentiment volatile and finely balanced. Let's unpack how this mix of geopolitical risk, credit stress, and surprisingly resilient growth is shaping risk appetite across assets. Risk sentiment today is best described as volatile and two-way, with sharply divergent signals across regions and asset classes. On one side, we have severe stress in parts of Asia, where South Korea's Kospi has suffered a record 12% one-day drop after a 7% fall the previous session, and broader Asian and European indices are down 5 to 6% in recent days. On the other, U.S. equities have rebounded, with the S&P 500 up close to 1% and the Nasdaq outperforming, helping the index sit only around 2% below all-time highs. Compared with earlier this week, when the backdrop was decisively risk-off with a clear stagflation undertone, today feels more like a fragile equilibrium. The Middle East conflict and effective disruption risk around the Strait of Hormuz remain the dominant macro story, but they are now interacting with evidence of robust U.S. growth, solid corporate earnings, and ongoing sector rotation rather than outright capitulation. Volatility is elevated and correlations have picked up, yet most global assets are still meaningfully positive year-to-date, which suggests that price action so far is more about degrossing and regional stress than a global liquidation. Cross-asset signals reinforce this mixed picture. There is clear de-risking in global equities and parts of credit, alongside heavy flows into cash, money market funds, and defensive currencies like the US dollar and Swiss franc. At the same time, ETF trading volumes have surged as investors use them to buy dips, and crypto assets such as Bitcoin are outperforming equities, acting as an alternative hedge amid geopolitical uncertainty. The result is a market that is nervous and headline-driven, but not yet in full risk-off mode, with downside macro risks competing against still supportive fundamentals. The most important bearish driver remains the Middle East energy shock and its inflation implications. Conflict around the Strait of Hormuz has already embedded a substantial war premium into crude, with around $19 of the current mid-$80 oil price attributed directly to conflict risk. Analysts warn that if disruptions to shipping lanes persist, as much as 20 million barrels per day of flows could be threatened, a potential shock up to 15 times larger than what we saw around the Ukraine invasion. This supply risk is feeding quickly into inflation concerns. European natural gas prices have surged on the order of 70 to 75% since the conflict escalated, and UK pump prices are already up 5 to 10% before any confirmed physical shortage. Rule of thumb estimates suggest that a 10% move in oil can add around 30 basis points to headline inflation over 6 to 9 months, and sustained high oil and gas prices could add roughly 35 basis points to Eurozone inflation on their own. Those pressures are pushing European bond yields higher, with markets flirting with the idea of an additional European Central Bank hike and fewer Bank of England cuts, while in the U.S., a 20-cent jump in gasoline prices in 2 days and an expected 3.1% core PCE print are complicating hopes for rapid rate cuts. The growth side of the mandate is also under strain. Europe looks particularly vulnerable, with several insights flagging that prolonged high energy costs could erode earnings power, especially in energy-intensive German industry and in sectors like chemicals and luxury that are already facing demand headwinds. Emerging markets such as India and Indonesia have seen their central banks intervening to support currencies after higher oil reignited inflation concerns, underscoring how an energy-driven terms of trade shock can spill quickly into foreign exchange and policy. Bond markets are currently pricing the shock as relatively short-lived, which limits the immediate damage to valuations, but that also means a prolonged or worsening disruption could force a second, more painful round of repricing across rates and equities. The second major headwind is private credit stress, concentrated in leveraged software lending. Blackstone's flagship private credit fund has faced record redemption requests of roughly $3.8 billion, prompting senior executives and the firm to inject about $400 million of their own capital to bolster confidence. Retail investors are increasingly uneasy about liquidity, while institutional investors mostly remain committed, creating a divergence in risk appetite and raising questions about when and how managers might use gating provisions. Beneath the surface, the risk is highly sector-specific. Software companies account for only about 1% of U.S. firms, yet they represent roughly 23% of direct lending exposure, and leverage in these loans can run as high as 20 times EBITDA, far above public market norms. Several analyses point to potential default rates of up to 15% for highly leveraged software borrowers in the 2027 to 2028 maturity window, as refinancing becomes challenging and capital to extend or roll loans becomes scarce. For portfolios, this creates a nuanced picture. On the one hand, credit markets more broadly are described as normalizing rather than breaking, with investment-grade spreads widening off generational lows but no clear signs of systemic dysfunction and liquidity still available. On the other hand, some private funds are reportedly selling their best-performing loans to meet redemptions, which could leave remaining portfolios increasingly concentrated in higher-risk, software-heavy exposures. That dynamic raises the risk of markdowns, distribution pressure, and eventual defaults, even if spillovers into the regulated banking system remain limited. The third bearish driver is clear de-risking and a pronounced flight to safety. Asian equities have borne the brunt so far, with South Korea's Kospi suffering its worst two-day decline since the global financial crisis and momentum trades in high-flying sectors reversing sharply. European, Japanese, and emerging market equities have also pulled back around 5 to 6% in recent sessions, signaling broad degrossing rather than simple sector rotation. Flows data and asset behavior confirm that investors are building defenses. There has been a notable shift toward cash, gold, and short to intermediate-term fixed income, with global money market fund assets rising and strong inflows into U.S. government and Treasury-focused funds. The U.S. dollar remains strongly supported as a classic safe haven, with expectations for euro-dollar to drift lower in the near term and oil importers like the yen under pressure, while the Swiss franc is also benefiting. Even within havens, the story is nuanced. Gold continues to attract steady central bank and retail buying as a hedge against inflation and macro uncertainty, yet some views suggest its short-term upside looks limited after recent geopolitical hedging flows. Crypto assets, particularly Bitcoin, are simultaneously behaving as both a risk asset and an alternative haven, rebounding sharply and outperforming equities as their borderless, sovereignless nature is seen as insulated from direct geopolitical disruption. This mosaic of flows points to investors prioritizing liquidity and optionality, even as select risk assets remain well supported. On the bullish side, resilient U.S. growth and earnings are providing a crucial anchor for risk sentiment. Recent U.S. economic data show the services sector expanding at its fastest pace since 2022, while service price pressures have eased to an 11-month low, a combination consistent with a soft landing narrative. Alongside that, strong corporate earnings and guidance, including from key technology and semiconductor names, are supporting a rotation back into prior market leaders after the initial geopolitical shock. Price action in U.S. equities reflects that resilience. Despite earlier volatility from the Iran conflict and private credit worries, the S&P 500 is trading only about 2% below all-time highs, and U.S. indices recently rebounded, with the S&P up roughly 1% and the Nasdaq up nearly 2% on the day. That bounce comes even as credit spreads have widened from extremely tight levels and geopolitical headlines remain intense, suggesting that many investors still have confidence in U.S. economic durability. The policy backdrop is challenging, but not yet choking off growth. Federal Reserve officials continue to signal no rush to cut rates as long as inflation remains above target, and there are credible forecasts for the 10-year Treasury yield to grind toward 4.7 to 4.8% by year-end. At the same time, core inflation is described as still on a disinflationary path, which could give the Fed some flexibility later, especially if labor market conditions remain stable. For now, that mix of firm growth and measured policy restraint is helping equities absorb external shocks, even if it keeps the cost of capital elevated. A second supportive driver is the broadening of equity leadership beyond the U.S. megacap technology complex. There is a growing shift in flows away from highly concentrated U.S. tech positions and toward mid-caps, small caps, and especially international developed and emerging markets. Sectors like industrials, materials, and consumer staples have posted double-digit gains year-to-date, even as some headline tech names have underperformed, indicating that fundamentals rather than pure momentum are increasingly driving returns. Portfolio positioning also reflects this dispersion. Managers are favoring healthcare, technology enablers, materials, and energy, and they are selectively buying back beaten-down groups such as travel and leisure in Europe, despite persistent headline risk from the Middle East. UK equities are seen as relatively resilient given their high weights in defensives, energy and aerospace and defense, and European energy names are cited as potential beneficiaries of higher crude, even if recent trading has been choppy. Newer market structures are reinforcing this broadening. ETF trading volumes have risen sharply, with many investors using them as tactical tools to re-enter the market and buy dips, which can create a stabilizing effect and a perceived floor under indices. Meanwhile, developments such as a major digital asset firm gaining access to a Federal Reserve master account, alongside the sharp rebound in Bitcoin and other crypto assets, point to digital assets becoming a more integrated part of the cross-asset risk landscape. Together, these trends suggest that even as one part of the market de-risks, other segments are still expressing risk appetite in more diversified ways. The final bullish driver is that several buffers are tempering the most extreme energy shock scenarios, even as risks remain elevated. Current oil prices are seen as reflecting a justified risk premium rather than an immediate physical shortage, with spare production capacity, strategic petroleum reserves in the US, China, and Europe, and the possibility of additional sanctioned barrels all providing some cushion. Alternative export routes and land-based infrastructure can partially offset reduced traffic through the Strait of Hormuz, and sluggish global demand growth means that price-induced demand destruction could also cap further upside. Supply dynamics outside the Gulf add another layer of resilience. Excess crude production from the U.S. and Canada is currently estimated at close to 8 million barrels per day above immediate demand, which could put downward pressure on prices into year-end if the Middle East disruption does not worsen. China is flagged as relatively insulated thanks to diversified energy sources, ample inventories, and an ability to reroute trade flows efficiently, suggesting that not all major economies are equally vulnerable to the same shock. These buffers do not remove the risk, particularly if the Strait of Hormuz remains effectively closed for a prolonged period, but they help explain why markets are not yet pricing an outright crisis. Bond markets, for now, appear to be discounting the shock as transient, and some investors expect that crude could fall back if there is credible diplomatic progress. The key variables to watch are the duration and intensity of shipping and infrastructure disruptions, the pace of any reserve releases, and whether energy price gains start to bleed decisively into core inflation. How those factors evolve will determine whether today's volatile but balanced risk sentiment tips toward a more durable risk-off or normalizes into a renewed risk-on phase. To sum up, risk sentiment today is volatile and finely balanced. A Middle East-driven energy shock, with clear inflation and policy risks, and mounting private credit stress in highly leveraged software lending are pulling the tape toward caution, reinforced by degrossing and strong flight to safety flows. Against that, resilient U.S. growth and earnings, a broadening of equity leadership beyond the megacap complex, and meaningful buffers against the worst energy scenarios are helping to keep equities from tipping into full risk-off. For portfolios, the key watch points are the persistence of energy disruptions, the path of inflation-sensitive rates, and how private credit behaves as maturities approach and redemptions continue. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.